Hello. Today, I wanted to share with you a concept that is revolutionary. It's going to actually help you to pay down your mortgage in 5 years, pay off all of your loans in the quickest amount of time, and you don't even have to change your budget. You don't have to change your lifestyle. You don't have to go on the beans and rice diet, nothing like that. And it all starts with transferring your debt from amortized debt to simple interest debt. Now, I know maybe some of you don't know what that means. Don't let that intimidate you. I'm going to explain the whole thing in this video. All right? So, first of all, what we want to do is we want to take the average American salary, which is $60,000 a year. That's $30,000 for the husband, $30,000 for the wife. And we want to break that up into monthly increments, which is $5,000, right? $5,000. And where does that $5,000 go? Into a checking account. Is that right? Absolutely. So that $5,000 goes into the checking account and savings. And you know what? When you live like that, you're actually living on a cash basis, which means that you're going to divvy out the pie, right? That means your mortgage payment, which is $1,200, you better not touch that mortgage payment, because if you do, you're not going to be able to pay the mortgage for that month. All right, so let's take that mortgage payment, let's put it over here where the loan section is, and you're paying $1,200 a month, $200,000 mortgage at 6%, right? And not only that, hey, let's say you got a couple cars, right? You have a couple cars, and that's going to be $600 a month, okay? So these are your loans, and we're going to put the $600 a month over here, and this one as well. You know what? This was amazing to me. Did you know that the average credit card liability is $600 a month? Crazy, right? Now, here's some of you saying, no, that's normal, right? Oh, man. So the average credit card liability is $600 a month. Let's go ahead and put it over here where the lines are. And let's say you have a $15,000 limit, $12,000 balance, $600 a month at 21%. Now, right here, I'm going to stop right here, and I'm going to say something. Everything that you know or think you know about the banks came from the banks. Now, I hear some of you saying, well, no, that's not true because banks believe in credit cards. I don't believe in credit cards. They want you to think that way. Case in point. Say you don't believe in credit cards, but month after month, right, you're getting credit card applications. And you're just throwing them away until all of a sudden you get a cute kitty credit card application, right? And you're like, oh man, I love cute kitties, right? Okay, so you fill it out, they send you the credit card, and you put it in your safe because you don't believe in credit cards. Well, just like what happens in almost all of our lives, there comes a time where you have hit the end of your money and there's still some month left, right? So now you're in a dilemma. You're thinking about, going to Canada, maybe selling a couple of kids, and then all of a sudden an idea comes into your mind. The credit card, cute kitty, right? We can use that credit card. Let's go ahead and buy some food, let's go gas, that big screen TV when the wife's not looking, and then all of a sudden, as you're going to the grocery store, you're racking up all of this debt. Now you're at $12,000 in debt. Now, when you're at $12,000 in debt, can you afford to pay that off? No. So what do? You stretch it out, which is exactly what the banks want you to do. Because when you stretch it out, the banks receive interest. How much does the bank make off of you when you swipe and then pay it off immediately? Nothing. But you see, legally, they have to allocate $12,000, take $12,000 from their lending pool and give it to you. That's a risk. So they don't want you to behave that way. All right? They want you to behave this way, paying $600 a month continually. So let's go over here and let's finish our model here. We have $1,200. We spend $1,200, right, for the expenses. I mean, that includes the cell phone, that includes eating out, that includes things like, hey, the groceries, the gas, you got to get to work, right? And so that's what that includes, the $1,200 does. And so we still have $1,400 left. What do they tell us we got to do with that? Put it in savings. Put it in the savings account. Savings account. Now, the reason why I put it in quotations like that is because the banks can call it whatever they want. It's just an account that they've labeled savings to make people feel good about what they're doing. Watch this. Say you've gotten real good at saving and you've saved up $10,000, right? Well, there comes a time where as you're saving, the kids, you've multiplied in kids, you need more seat belts, the family's growing. So you spot out a nice used minivan. Okay, so that nice used minivan costs $10,000. Now you've got $10,000 in your savings account. Why wouldn't you use the $10,000 in your savings account? Because you were told to save for a rainy day. You were told to save for emergencies, right? And so what you do, you're not going to touch that savings, right? You're going to go to the bank and they are going to lend you $10,000 at 6%. Now, this is what they've done. When you went to the bank, all of these people are contributing to the savings account, to their savings account, right? Including you. And so what you've done when you got a loan for the $10,000, they said, here you go. Here's your $10,000, and you legally owe us 6% on your $10,000 because you have contributed to the lending pool. Isn't that awesome? No, that's not awesome, all right? Okay, so that's how savings accounts work. And so you're saying, well, so how can I get out of this? Look at all of this. This model right here shows $5,000 coming in to your checking account and $5,000 going right back out, which leaves you with a cash flow of zero. It's a cash flow of zero. And that's the problem that I have with this model. This is not a wealthy model. This is an employee mindset model. Because employee mindset is always concerned about, how much am I going to make, right? But the wealthy mindset is, how much does it cash flow? So how can we utilize this so that we, as the wealthy mindset now, can utilize our money and make our money work for us? The first step that we can take is we take our $5,000 that we get monthly and bypass the checking altogether and go straight to our credit line. That's right, you heard me. Take all of your monthly income and go straight to the line of credit. Now, why would we do that? Well, first of all, you see that $600 a month payment? If we're contributing $5,000 to our line, do we need to budget for that $600 a month? The answer is no. So what are we going to do? We're going to take that out of our budget and we're going to add it to our cash flow. And because we don't save, because we're not chumps, right? Any chumps in the room? That $1,400 is going to go down here to our cash flow. So that now we have a total of $2,000 in cash flow. All right? Everybody see how I did that? That's awesome right there. So all of a sudden, your cash flow is increasing. So with your cash flow increasing, what we want to do is we want to model how this is going to play out. So we go ahead and we graph it. You have $12,000 in a balance, and you have $15,000 in a limit. You have a $15,000 limit. Now, watch how this plays out. This is going to be awesome, okay? When you're contributing $5,000 a month into your line of credit, your balance goes down dramatically, like this. Now, there's still $3,000 coming out, right? Because there's not $5,000 coming out anymore. Where the wealthy mindset, there's only $3,000 coming out. All right? So the expenses, they go back up, they come back down next month, next month, next month. How many months is it going to take you to pay off that $12,000 line of credit, that balance that you had on your line of credit? 6 months. Is that awesome or what? Isn't that awesome? Now, if you would have done what the banks wanted you to do and pay the minimum amount, $600 a month, it would have taken you 4 years. It would have taken you 4 years if you would have done what they wanted you to do. But because you have the wealthy mindset, it's taken you only 6 months to pay down $12,000. That's how your money can work for you. Now check this out. We're not done. We have another problem though. You know what that problem is? We're out of line of credit debt. We're out of debt. So what are we going to do? Remember, the wealthy need debt. Absolutely. There's good debt, and then there's not so good debt. What we want is good debt. Good debt is assets. Now keep in mind, your lines of credit are only going to be used to buy assets and emergencies. Okay? So remember that. This is for assets and emergencies. And you say, well, wait a minute. Where's your emergencies there? Well, can you afford to buy new tires right here? Can you afford another emergency? Maybe right here when you've paid it off, or even when you have like $2,000 there? You got a $15,000 line of credit, right? So that's your savings account as well. It's your checking and your savings account. Say it with me. Your line of credit is your checking and your savings account. It's awesome. So now, you know what happens when you have such a rich history of paying down your line of credit like this? What are they going to say? Mr. Wallace, you've been such a good steward of this line. We're going to add $10,000 to your line. So now the line is at $25,000. Now that's never going to happen to your savings account. You're never going to have someone come up, shake your hand and be like, listen, you've been such a great saver. We're going to add $10,000 to your savings account. And let me know if you ever see a bank that does that, because you never will. Okay? Now, back to this. We need debt because we got to pay off our loan. Yes, you heard me correctly. We need debt. So before we get into how we're going to pay this off, that mortgage off in 5 years, guess what? This is how amortized loans work, okay? So amortized loans work like this. You take your 30-year mortgage, and you're paying $1,200 a month. It's going to be divided up like this. Your principal is going to be, your interest actually is going to be $950 is going to interest, and $250 is going to the principal. Now, it's going to be like that for a while, right? Till you get close to paying it off, right? Because at the end, it's going to be the interest, it's going to be $250, and then the principal well, eventually there will be more money going towards the principal towards the end of that 30-year mortgage. Now, how many people actually get to the end of their 30-year mortgage? Less than 1% of Americans who are current on their mortgage. Absolutely. So, what do we usually do? I mean, what do most Americans do? There you go. They refinance. So they're right down here, and the average is 7 years. In 7 years, they refinance, and they start the pool all over again. They start paying high interest. So they pay all that high interest in the 7 years, right? And they get stuck in that loop. So they think refinancing is a good idea, and refinancing is not a good idea, right? Because let's jump ahead to 48 months and see how much you pay in interest in this model, okay? So let's say we jumped ahead to 48 months. So 48 months. In 48 months, paying $1,200 a month, you would have paid $57,000. And here's how your $57,000 is going to pan out. This is how it's going to be divided, okay? Watch this. You would have paid $13,000 in principal and $44,000 in interest. Isn't that interesting, right? Do you like that? I don't like that. Listen, we need another way to work our finances. We can do much better than that. And I'm going to show you, okay? Now, what we're going to do, because we're the wealthy mindset, we're going to go ahead and pay down this principal like a madman, right? Like a mad woman. Let's do this. So, we take out $13,000, right? And we're going to put that towards the mortgage. So we write a check for $13,000, put it toward the mortgage. We bite off the back end of this huge mortgage. And when we do that, we do not have to pay all this $44,000 in interest. Each time we do that, we are negating the $44,000 in interest. So we're saving a ton on interest in 1 minute. Now, watch this. The $13,000, and we're just going to do it the same way that we've paid down the $12,000. We're going to pay down the $13,000 the same way, okay? So we're going to go put in our $5,000. You know, we have $3,000 expenses, you know. And if it took us 6 months to pay off $12,000, how long is it going to take us to pay off $13,000? 6.5 months, okay? And now I want somebody to do the math on this. $13,000 multiplied by 21%. 21% is an annual interest rate. We pay off in 6 months. Divide that number by 2. You're going to get $1,365. So we're going to round it up to $1,400, okay? And that's how much interest you owe in it. So let me get this right, okay? Would you rather pay the principal payment for 48 months and spend $44,000 in interest to pay it off? Or would it take you 6.5 months to pay off the $13,000 in principal with $1,400 interest? Let me give you a hint. Oh, wait. No, not a smiley face. This one's a frowny face, right? Yeah. So that should be a good hint to you which one you should choose. Would you rather pay $1,400 in interest or $44,000 in interest? So, I mean, not only is utilizing your line of credit shorter, it's less expensive, you know? That's amazing to me. So now, what you're going to do is you're going to continue to do that. So once you've paid off the $13,000 after 6.5 months, right, you're going to continue to pay that $13,000, right? And you do that month after month after month, and in 5 months, count them, 5 months, you're going to get rid of a 30-year mortgage, and you're going to save tons on insurance or in interest, okay? Because the bottom line is, in your truth in lending statement, the government makes the banks tell the truth, okay? And they're going to let you know that, listen, at the end of the 30 years, you're actually going to pay $420,000 to us, right? Okay, so now that we have jumped ahead, let's jump ahead. We've already paid off our mortgage. So now, what are we going to do? Man, it's just going to go ahead and we're going to increase our velocity, right? This strategy is called velocity banking. So now that we are done with our mortgage payment, we can take this off the budget and put that down here to cash flow, okay? That's what we're going to do. We're going to add $1,200 to our cash flow, which means $3,200, right? So now our graph is going to look like this, because we're just paying things down. We're actually paying off the car in like a year or less, because our car, man, that's another payment that we budgeted for, right? Well, look, we no longer have to budget it if we're having that cash flow and we're using it to pay down like a mad person, right? So $600 is going to our cash flow, and now we have another problem. But before we jump into our other problem, let me ask you a question. Can I ask you a question? I want you to tell me, which would you, say you owed me money, okay? But I'm a nice guy, just ask me, I'll tell you. And I was gonna let you pick what interest rate you wanted to pay me back at. Which one would you choose? Would you choose the 6%? Or would you choose the 21%? Now, I know that most of you would pick the 6%, but let me graph this out for you, okay? This is what happens when you pick the 6% over on this side. Let me write something on the board here. I'm going to write 6 degrees Celsius. I'm going to write 21 degrees Fahrenheit. And I'm going to ask you a question, which one is warmer? Now, most of you I know said 6 degrees Celsius is warmer. But how can you say that? This number is smaller than this number. 6 is smaller than 21, right? That's what we got taught in school. It's a different unit of measure. Exactly. And did you know that the banks are doing the same thing to us? Look at this. Over on this side, all your loans, your student loans, your car loans, your home loans, right? They're all amortized. Not only are they all amortized, they're one directional, meaning that you can't swipe your mortgage at the gas station, right? Once you put in your money, 100% of it is gone. Okay? That's what that means. Over on this side, though, the lines of credit, it's simple interest. And it's revolving, meaning once you pay in the $600 a month, guess what? You can use that money again, and you only lose 21% of it, which means you got 79% more of your money. So another way to put it is, say you have some water. Perfect. Say you poured out all of your water into the kitchen sink. That's a loan. Now come on this side, the line of credit side. Say you pour out just a little bit of water in the kitchen sink, but you still have some water to drink. That's the line. And that's why utilizing lines of credit is so much better than amortized. Now, which one would you rather utilize? Which lending tool? That's right. You're smart. The The lines of credit are where it's at. So, now that you're done paying off these loans, you've got another problem. You got another problem. And what's that problem? You're out of debt. So, what are we going to do now? I mean, we're out of debt? Is that a problem? It sure is. But remember what we utilize debt for. Remember what we utilize lines of credit for. We utilize lines of credit for assets and emergencies. So guess what we're going to buy next? We're going to buy an asset. So we go over here and we say, you know what? Let's take out $20,000 because you got $25,000, right? Let's take our $25,000 and we're going to make somebody happy because we're going to get them out of trouble of foreclosure because these people are almost in foreclosure and we're going to save them. What we're going to do is we're going to do a $20,000 down payment. Now, what I mean by that is we're going to get with someone who's in trouble, can't make their mortgage payments. We're going to do what is called a subject to. The mortgage is going to stay in their name, okay? But what we're going to do is we're going to pay their bank, $10,000 to catch them up on their payments, right? And then we're going to utilize our $9,000 to rehab this rental, because that's what we're going to use it for. We're real estate investors, right? And then we're going to give the former owner $1,000 to get an apartment somewhere, okay? So that's where our $20,000 is going to go. We have a $100,000 mortgage, okay? And we're just going to keep on making the payments. Now, why would someone say yes to us doing this? Well, number one, they're going to avoid a 7-year ding because it's only a 2-year ding, okay, 90-day delinquency, right? So now they're going to avoid foreclosure, and also their credit is going to be increased. The more these tenants that we're going to put in here, the more they pay the mortgage, right? Their mortgage is going to be being paid, and their credit limit or their credit score is going to increase, and their chances of getting a house again is going to increase as well. Okay, so we're really helping these people out in a major way. Okay, so let's say the average rent is $1,000 a month, and it is across the United States. $1,000 a month minus $600 in mortgage and expenses is $400 a month. That's $400 in what? $400 in cash flow. So we're going to add that $400 down here, right? $4,200 in cash flow. Woo! So now that we've had $4,200 in cash flow, that velocity is just going down. If we paid off a $200,000 loan in 5 years, how long do you think it's going to take us to pay off $100,000? In 2 or less, right? Because, man, we are just bosses and we are wrecking the place, right? So now what we're doing is we're paying off this house. Now we have the house paid off, right? We got great tenants, okay, because we know how to screen. We have our education, right, and knowing how to screen the tenants and everything. And now, what do we do? What do we do that we have no more payment in the house? Listen, we go to the bank and we tell them, listen, I know you're pushing mortgages. You're wrong. Let me ask you about a tool that you didn't teach me about, which is called a HELOC, okay? HELOC. That stands for Home Equity Line of Credit. Say the value of this house went to $120,000. How many homes, how many $20,000 down payments can you make with a $120,000 line of credit? Huh? 6. So we're going to find homes that are just like this one. And we are going to get them, put tenants in them, and have them all cash flow at a rate of $400 a door. So that's 400 times 6, which equals what? $2,400. What's your total monthly cash flow? Your total monthly cash flow is $6,600. You want to stop there? I mean, you can. You can stop right there. But I mean, because you don't want to, you're not going to. So, you're going to go all the way up to 42 properties. And in 10 years, you're going to be cash flowing $42,000 a month. That's $504,000 a year. That's cash flow. That's money that you don't have to work for. Whether you're dead, whether you're sick, whether you don't want to go anywhere, you're going to be cash flowing $42,000 a month. A month, not a year. And you can utilize this model. This works. And this is working. This is working for me. This is working for others. And it can work for you as well. You see, your mindset has to be out of the employee mindset. Okay? I want you to write this down because this is extremely important. Okay? E, employee. Okay, that stands for employee. This is how the employee thinks. They think cash equals currency. I'll go out and buy things with cash. I'll go out and pay my bills with cash. Right? The wealthy say that leverage is currency and cash is velocity and debt pay down. So what does that mean? That means we buy things, the wealthy buy things with their assets, okay? And with the cash, we utilize all of it to pay down our debt. Like we did with that line of credit. Like we did with this loan here. We transferred it out of the amortized loan into the simple interest loan and saved thousands in interest, okay? Let me tell you something. You can utilize this model for your own life. And don't forget that with mortgages, you can only have Fannie Mae and Freddie Mac say that you can only have 10 mortgages in your name. But, I mean, what if I have a mortgage in your name? What if it's in your name? What if it's in your name, in your name, in your name? I'm limited only to the amount of people that are on the planet. Times 10, because each of them can have 10 mortgages. I'm telling you, this thing is brilliant. So put it to work in your life. Reach out to me. Show me. Give me some feedback. You know what I mean? I welcome feedback. And let me know how I can further help you. Just comment in the section below. Like it, share it. Let people know that there are methods out there that can help you and not hurt you. You can actually and practically put your money to work for you, period. Thank you for watching. God bless you. God loves you. God smiles when he sees you.